Joining us live from the CME Group is Larry Shover of Efficient Capital Management. Last month, Larry told us investors have no confidence in the housing market and a government boost could be well received. Also with us, Nick Sargen, Chief Investment Officer at Fort Washington Investment Advisors, where he helps manage more than $30 billion. And Nick, you've said that if the market really believed in the double dip story, then material stocks would be falling. Since you said that last month, the S&P Materials Index has gained about 10%, and we have had not a bad month in September, although we've seen with the July-August cycle how a good month can be quickly wiped out. What do you think now about the chances of a double dip, Nick?
I think those risks have faded. And, most important indicator for me was that the decline in the weekly jobless claims numbers on a sustained basis. I was getting nervous when you were getting up to the 500,000 mark. Now we're kind of where we were before that. So I think it's a low growth trajectory. The other thing is I was just on a trip to China. You've been emphasizing that. The question there was, is the Chinese economy slowing significantly? And the answer is it's moderated from double digit. But I came away feeling much more calm that they're probably going to be growing 8-9%, which still is critical for the world economy.
Not worried about the economy there overheating or a property bubble bursting or any other kind of bubble in that situation seems not unlikely?
Yeah. The way I came away with was that I think it's less likely there's a bubble in the residential side simply because of the huge migration to the city. So there's still strong demand. There is more uncertainty on the commercial side. But at the end of the day, most people I talked to thought the talk of bubble was exaggerated. However, the story is if they're wrong, what would China do? The Chinese government's the biggest stakeholder. They would probably step in. And the difference from the U.S. is with $2.5 trillion in Forex reserves, they have the wherewithal. So my feeling is that if it were to happen, it could be contained. It wouldn't be a replica of the U.S.
Hey, Larry, I want to bring you into this conversation. We've been talking a lot about the conversations between President Obama and the Chinese premier. A lot of it, obviously, about the Chinese currency, the yuan. I'm just curious how closely you guys are paying attention to some of those discussions that are going on. Larry.
Yeah, no. People in the pit are very worried about it, although the market has been very good the last couple of days. People are worried about the incorrigible teenagers that seem to be running the government, and with Larry Summers resigning, sounded like the voice of reason in Washington. People don't know what's up, and it feels like the last hour has been a really controlled down move, but people are a little skittish about the future.
Nick, I want to go back to you. I mean, should investors, in your view, feel comfortable enough to get back into the market at this point if they haven't already?
I've put it the following, that I think the good news is I was concerned in the summer months about, the risk of a double dip. I wasn't my baseline, but I didn't like what I was seeing. I think right now we're back to more of a mixed market. So if you've been very underweight, it might not be a bad time. But I lack the courage of convictions to go and tell investors that the worst is behind us because I think this, especially the data on jobs, is still going to be lackluster. There'll be growth, but it won't be enough to move the needle on the unemployment rate. And as long as that's the case, you've got policymakers still in play.
Well, and Larry, I mean, you mentioned housing last time you were on. We saw since then, prices come down, I think 3.3%. You saw existing home sales at the second lowest level in a decade. Is this a concern that, we've been asking the question, are we stabilizing or sliding along the bottom for months and even years now? I mean, when do we see it turn around?
Oh, it's going to be a while, I think. And tomorrow is going to be very telling because we have both durable goods and new home sales. And the last new home sales number was really bad. More importantly, though, I think along with that, if you look at March of 2009, everything has been highly correlated, all asset classes, and people have nowhere to hide. Everything has rallied. Treasuries, stock market, commodities, foreign currencies, everything has rallied. So unless an investor, which institutionals seem to be getting this picture quickly, unless they're in alpha-based strategies, it's just a flip of a coin right now.
That doesn't sound so reassuring, Larry.
It doesn't sound reassuring because it's like a binary trade right now. It's like you're risk on, risk off. Everything has rallied since March of '09. There really is no place for somebody to hide unless you're willing to bet on somebody who is investing in trader skill, not necessarily magnitude or direction.
Nick, if you are, though, looking for a place to hide at this point, what would you suggest to investors?
You know, probably the area that I still feel relatively comfortable with would be actually in the bond market would be the high yield, the higher quality high yield segment, the double Bs, single Bs. Why? Basically, the argument is that people are looking for yield, and it's still on a relative basis in that segment of the market. Two, people are worried about the economy, but don't forget the corporate sector has been improving, and the default rates have come down dramatically. So I view high yield as a hybrid between equities and regular bonds, and in my place, it's still going to be an attractive space for investors.
Nick, let me ask you. You know, I'm looking at Nouriel Roubini here. He's about to come on and talk to us about policy prescription to try and help boost jobs, which you really haven't seen yet out of Washington. Even though everybody has been kind of talking about solutions that they think would work, you haven't seen them legislated. What if Washington did something positive, like a payroll tax holiday? Do you think that would be reflected positively in the markets?
I can only speak for myself, but Matt, that's one of the the policies that to me does make sense. It's going directly to the root of the problem. It's creating incentives for businesses to bring on workers. My whole theme is that you've got the companies sitting on excess cash of over $1 trillion. So that's the sector that's got the money. It's up to Washington to come up with strategies to make that sector comfortable about deploying the resources to hire people.
Well, Larry, you know, a lot of changes in the Obama economic team at this point, or potential changes with so many leaving. Do you feel like there's the wherewithal for them to bring in folks that are going to shape an economic policy that's going to be more conducive, more friendly to business?
I should hope so, because that's what we need. We need somebody who understands cutting corporate tax rates, dividend taxes, things that help businesses, because at the bottom line, if your boss isn't doing well, you're not going to do well. And it's pretty simple, and we just don't need we don't need more intellectual pollution in Washington. We need somebody who understands how business works, and that the fact that business does well, employees will do well, and employers will end up hiring people. It's as simple as that.
Hey, Nick, it's Dominic here. We've been talking in the newsroom for a while about this idea of, high yield and maybe even preferred securities. But it seems as though every time we kind of have this rally, the stocks that kind of lag are the ones that are kind of more cyclical in nature, right? Does this speak to anything of a theme? Are investors looking more towards defensive names, that they buy those on dips rather than these growth stocks anymore?
Well, I think, yeah, exactly. I guess our theme is the following. We think we're in a muddle-through scenario. So when we're, as far as equity investors, we tend to be value-based. And what are we not going to do in this environment? If I don't have a lot of confidence about long-term earnings prospects, I don't want to pay up as a value investor a lot for a premium on what companies can earn on future long-term investments. So, and I think then with the cyclicals, it just does go with the ebbs and flows. I think that the difference, the reason I was focusing a little bit more on the high yield space is what I'm in effect saying is, where people, what do they want if they're in a bonds? They want yield. They're not getting it on investment grade corporates, which we liked previously. So you are still getting it in high yield. I don't like high yield if I'm in a double dip, but I don't think I'm there. And at the same time, I'm focusing on the higher quality part of the high yield space. So that would be double B, single B paper.
Adam, are you willing potentially to just, ride some of these bonds back down if they do go back down and just pocket the yield, pocket the coupons on the junk?
Oh, are you asking me, Matt?
Yeah, Nick.
Yeah, I would say for the time being, I feel comfortable with the high yield as a buy and hold strategy. Here's the problem we face on most bond investors in investment grade corporates. Our corporate bond portfolio has a current market value of, let's say, 110 for 100 par. So you sit here and you say, I've got an asset that's had a huge gain. What can happen? Well, some people say, well, if inflation or interest rates go up, it will sell off. Okay, but let's say it doesn't. you're still sitting on an asset that over time will revert towards par. So the tricky thing for a bond investor now is knowing, when do I get out of that trade?
Okay.
And if so, what do I get into?
Hey, guys, we've got to run. Larry Shover of Efficient Capital Management, Nick Sargen of Fort Washington Investment Advisors. Guys, thanks so much for joining us.